So we're continuing the week, or I guess the series on our legacy virtual trainings. We've had a lot of really, really good ones. If you haven't seen them, you can go back through my social media. We go live on Facebook, and you can go and watch some of the past ones. And we've been doing them every Friday. It's been a lot of work on the team. It's been a lot of work on logistics and a lot going on. But we're getting some really, really good feedback and great engagement and a lot of positive insights and stuff from people. So hopefully you guys are getting a ton of value, and we have one more next week. Next week is essentially all about white collar wealth building. So if you are earning a lot of money and it's you responsible using your hands, your own efforts, your own having to be there and trading your time for money, but make a great multiple six-figure income, and you're trying to figure out, how do I generate more wealth, more residual income, more passive income? Next week is going to be for you. We'll be talking a lot about how to start buying assets, accumulating assets. Like, let's say you're a dentist or a doctor and you rent your current office. We're going to be talking a lot about acquisitions on real estate, how to have those conversations with your current landlord to try to buy your existing building or find another space locally. So we'll talk a little bit about that next week. We're just spending a lot more time on how to scale your income and how to scale your business and make it put it in a position for a future exit, for a future sale. So when you get a big pop of capital, make sure it's automated, systematized, the right people and processes in place, so that way you get the highest multiple for that. And then what do you do with that money? Next is you look for the passive investments, the residual investments. What does that process look like? What kind of things are out there? We'll be talking a lot about that too. So a lot of good stuff. I have multiple doctor buddies, dentist buddies, insurance agent owners. Who else is on that list? Attorneys that making money there. And I mean, every profession that you can think of people who are making a lot of money, but they're trading their time for money, who are looking to build some long-term wealth, will be on that. And so we'll be talking about a lot of those things. So, and I think for anybody who's not, even if you don't sit in that seat, I think understanding how the conversation is and what those folks are looking for in order to go and help them source deals or raise money, whatever that looks like, and how it can help you build your business is a great skill set, and some great insights that you'll be able to gain as well. So that's next week, and that will be our last legacy virtual for the time being. We have our summit. We have a big legacy family summit for our mastermind in New Orleans the following week, and then we're just kind of regroup and try to reflect on where there's a lot of value in these things. Would love to hear your guys' feedback on that, what you might like to see in the future. And see how our team can continue to provide as much value as possible for you. So, and then, I think what we'd love to do is try to get these going again, maybe in April and April, May, leading up to the summertime. So, but today we're all about tax credits, and the attorneys told me I could not call this the free money course or the free money training. And so I had to change the name, but it really is about gaining access to funds that many of us didn't even know were available to us, didn't even know that these things existed. Tax credits, conservation tax credits, historical tax credits, self-employment tax credits. A lot of the money that was printed over the past few years, the $10 trillion that was printed by the government since COVID hit, a lot of that is grants and tax credit money that's going towards people who know how to access it. And that's what a lot of this is going to be dedicated to, as well as tax strategy. So for the next 2 hours, from 10 a.m. to 12 noon Eastern time, we'll be talking all about tax credit, tax strategy, grants, all those kinds of things, in order to gain access to knowing what these things look like. So whether you are trying to gain access to cheap, free, low cost access to capital, reduce your tax liability through some of these tax credit strategies, or you're in the position where you're either going to sell a portfolio, sell a business, and you're going to have some taxable gains. What can that do? What can some of these resources do in order to reduce that tax liability that you might have? And so we got a lot of good stuff that we're going to dive into. and some real rock stars on here as well. So Chris Shakowitz is going to kick us off in a few minutes here. I actually have him coming out and speaking in New Orleans at a little bit more in depth and an extended time than what he's going to share today. And so I'm super pumped to hear him share some of his insights all about tax credits. And then we're going to roll into Melanie Sigma and Byron McBroom, who are members of Legacy Family. And they're like absolute ninjas when it comes to tax strategy. They're CPAs, CFOs. They used to travel and be part of Tony Robbins' organization. So the highest level entrepreneurs in the country have used these guys, and they're going to be spending about 30 minutes talking about the top things that you should make sure. Like, it's tax season right now. These are things you have to be asking your CPA to make sure that you're capitalizing on tax code type things that all of us have access to, that many of us are not accessing, and so you're writing bigger checks to taxes than you probably should be. Especially if you're an entrepreneur or a real estate professional. And so we'll be talking about some of those things. And I asked them to bring, like, the top 3, 5, 10 strategies that they see missed all the time on a lot of their clients that come over to them, that are easy, low hanging fruit, things that you can then take right to your tax advisor, your tax preparer this month. So talking with them, and then Adam Maggio, Mark Evans do a lot in the self-employment tax credit. It's if you were adversely affected by COVID, the government has a huge tranche of capital. You've seen it with like the ERC tax credits, the employee retention credits for some of the bigger business owners. Self-employment tax credits is another big component where there's this huge tranche of capital that's going to essentially, pay people for the adversities that they faced during COVID. And it's not even anything that I even knew existed until last month. And I was having a conversation with these guys. I was like, there's a lot of people who are either self-employed or run teams of self-employed people. Like, maybe you have a real estate brokerage, maybe you have some 1099 contractors that you work with, and or maybe you are a 1099 subcontractor in some capacity. And there's access to money, tens of thousands of dollars. That's, from what I hear, and we're going to learn a little bit more about it. That's why I asked them to come on and share some of that insight. That capital is accessible. It's pretty easily accessible in a way that you can. It's not hard to fill out the paperwork, submit it, and it's pretty quick to come around, assuming that you check all the boxes and stuff. So I think that's all good stuff. It's going to be access to money, access to grants, access to tax credits, access to tax strategy, or reducing your tax liability over the next hour and 50 minutes. And so is Chris Shakowitz on? I told him that I'd talk until about 10:15, but I think if he's ready to rock and roll, let's rock and roll, buddy. Right. Yeah, Chris, welcome. I appreciate you being here, and super excited to meet you in person as well in a couple of weeks. But yeah, Chris is a rock star in the tax credit space, came highly recommended actually from Melanie Sigma and Byron McBroom. Couldn't say enough good things about you and your firm and what you guys do. And I know the conversation that we had, we could have kept on going, right? We went over our time, and we could have kept on talking for hours and hours and hours. So I'm excited to hear what you got, and I'd love for you to take it away, and then maybe we can open it up for some Q&A toward the tail end of it.
All right, that sounds great. So is it all right if I share something?
Yeah, man. You got the screen and everything. It's all yours.
Great. Well, thank you for that introduction. So is my sound coming across good for everyone?
Sound great, man.
All right, thank you. Let's go ahead and... All right, so with half an hour, so our company has well over 40 different things we could be talking about. But what I thought I would do today is talk about the top 3 tax-efficient investments for real estate investors, and then talk about a specific scenario leveraging a 1031 exchange, and then go into a little known exit strategy around a 1031 exchange, and then talk about how you can use this whole strategy to supercharge your overall investment. Does that sound good to everyone? All right. Well, the first one I'll go through, and what I'll do is I'll go through some of these 3 different options relatively quickly, and then spend a little more time on the scenario where I explain how it gets used. So the first one is using solar. So everyone's probably aware that for solar, there's a 30% base tax credit for using solar, but there are some additional credits if you do things correctly. For example, if you do a solar implementation, if the contractor is using prevailing wages, there's an additional 10% adder, which would take it to 40% credit. If they're using 80% domestic content in their materials, that would take it to 50% credit. And then if you're in an energy efficient, whoever Rob is, please don't draw. Um, so, and then basically, if you're in an energy efficient community, you can get another 10% to the credit. Also, if you have an agricultural company or if you're an energy professional, like if you're doing things like adding alcohol to gasoline, et cetera, converting corn to alcohol. Those companies can actually get, or if you're an agricultural company, you can actually get credits that can go all the way up to 100% uh, for implementing solar. So in addition to that, you also have the option of getting a per kilowatt per hour tax credit in addition to the power that's generated for generating that solar power. So, and there's several specific rules apply and licenses that apply. So you have to get into a lot more detail to go into those details. The key thing here is that if you're thinking of doing solar, you want to be sure and check with your contractors before you purchase to see if they're using the prevailing wage, if they have 80% domestic material, they have energy efficient, or whether or not your building is in an energy efficient community to get those additional adders. So that's a quick rundown on solar.
And is that done, Chris, on a state basis, or is that a federal tax credit?
This is all federal.
Okay, so everything
And
here
you
is
could get
federal.
additional adders for state.
So if you spend $100,000 on solar, right out of the gate, you'll be able to get $30,000 of that back as a tax credit.
Yep.
Is
And
that
if that
accurate?
means that you're in, a state where there's no state income tax, that means that would be more money than you would have paid in taxes on that money.
Mm, love it.
All right. Yeah. So whoever Rob is, if you can get rid of those lines, uh,
Yeah, I don't know how that happened, but Rob, if there's any chance that you can clear your screen, there's a couple of lines and stuff on there. Yeah, and I don't know if there's a way that we can reduce, or
Maybe
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 unshare
stop
and then
share
reshare.
screen and
Yeah,
then come back in. I think we accidentally had the whiteboard on, so I just turned it off.
okay. Oh, there we go. Good job.
nice.
All right. So the next most popular one is called a 179D. So what does is it encourages you when you essentially purchase a new building to reduce energy consumption by 25% or more. And if you meet all of the requirements, you can get up to a $5.36 per foot credit. Sorry, deduction, not a credit. This would be a tax deduction. The property can be an older property, but it must be new to you, meaning that you purchased property. It isn't something that you've held for, 10 years or something like that. Um, any rental property can qualify, but it must be your trade or business. So it can't be your side job. You can't have a day job and then do this part-time. And then under new laws, there's a lot of different components that also qualify for this credit. So if you're doing work on the interior, the older law allowed you to do remodeling, drywall, interior doors, lighting, flooring, all kinds of stuff. The new law basically added things like HVAC, lighting, doing new insulation to roofing. The whole idea is that when you buy this property, that you're now reducing the energy consumption by 25% or more, and that's how you would qualify for the credit. And I'll get into an example of how to use this. Now, it's really important that you have to check the details here because the qualifications can be a bit tricky. For example, multifamily must be 4 stories or more to qualify, for example. So there's a devil in some of the details. Um, okay, so the next thing that I'm going to go through relatively quickly, most people have heard of this. It's called the cost segregation study. It's basically accelerated depreciation or bonus depreciation. So the whole idea here, if you buy a new building and you do any improvements to it, your cost segregation study can basically increase your depreciation by taking some of the assets and accelerating the depreciation. Instead of doing it over 39 years, you can do it over 5 years, 7 years, 10 years, depending on the type of asset that it is. So the cost segregation study was on the decline, where it was getting reduced by about 20% per year on its way out of the tax code. However, a recent change in Congress has reinstated, starting this year, the full cost segregation study.
And has that passed?
I believe it has passed.
Okay, I knew it was like on the floor, they were voting on it, but I wasn't sure if they actually uh did that. And that goes back to last year. So last year when it was 80%, and then this year was supposed to be 60%, they're both back to 100% now.
Right, they're back to 100%.
Hooah!
Yeah, most definitely. What that bill also did is it basically put an end to the ERC. So the employee retention tax credit, basically you can't apply for a new one after January 31st. That's how they're actually funding it. So any investment property that you've purchased for more than $750,000 is a good candidate to go see if an ERC will work for you. You want to create any major improvements before you begin the study. So if you're going to do a bunch of upgrades, do the upgrades, then do the study, so that those upgrades get counted into the cost segregation study. And basically, all we need to figure out a rough cut of what type of a return you can get is the property address, the purchase price, and the date purchased. Basically, we would run this through our company to get an analysis to get a rough cut, set up a meeting, have a conversation, and then from there you can decide if the dollars, the amount of deductions that you can get would make sense. The company that we work with basically has their own engineers, and they have their own accountants, so everything's done in-house, and they basically charge a flat fee instead of charging a percentage of what you save. Some companies out there will charge up to 30% of what you save. Basically, the way that we do it, it's a flat fee, so they don't take, based on the percentage of profit that you make. So it's important that the cost segregation study loses value over time, and sort of the tipping point of where it makes sense to do it. If you own a property more than 7 years, probably doesn't make sense to do the study. In some cases, it can if your building has a lot of equipment in it. But typically, that's kind of the tipping point. If you've owned the building more than 7 years, it probably doesn't make sense to do a study if it's just your average run-of-the-mill multifamily or warehouse or whatever.
Hey, Chris, what would you say makes sense for if you're acquiring a property and you want the tax credit or the cost seg and the accelerated depreciation this year? What would you say would be the balance of, hey, it doesn't make sense unless you're going to hold it for this long?
Typically you're going to get your money back in 2 or 3 years. So if you're going to hold it more than 2 or 3 years, that starts to be that balancing point.
Yeah, that's kind of what I've seen too. You don't want to do it if you're going to sell it next year, because then you have all the recapture and stuff. But if you're holding it for at least 3 years, I think it can make a lot of sense, because now you have access to that capital that you're not paying taxes. You can use it for reinvestment and see how it compounds over the next 3 years.
Exactly. And I'll show you an example of how that works.
Love it.
So what I want to do is to go through this scenario with a real estate investor. Here, I'm going to collapse this on the right. So basically, we have an apartment owner that has a highly appreciated apartment building. They want to buy a warehouse with as little debt as possible. They already started a 1031 exchange with us. It's a $1,000 flat fee. And then they want to maximize their income by increasing their return on capital. They want to make a tax efficient improvements and then reset their depreciation if possible. So how do we do this? Well, let's go into the details. So first off, if they're in a 1031 exchange, in this case, they're selling a multifamily and they're buying a warehouse, right? Well, as you guys know, with a 1031 exchange, you're going to take basically the proceeds from the sale, give it to an exchange accommodator, a licensed exchange accommodator, and then basically when you find the warehouse that you want, the exchange accommodator is going to give those proceeds through the purchase escrow to purchase that property. One of the downsides of a 1031 exchange is you have to keep the original depreciation. So basically, in this case, this person, well, I'll get into the details in just a second, but the rules are that you have to have an investment property that you're selling, an investment property that you're buying. You have to buy something of equal or greater value. You have to replace the equity and you have to replace the mortgage. And you keep your original depreciation. So day one of the 1031 exchange is the day that escrow closes. 45 days to identify a replacement property, 180 days to close. This is just a quick reminder of how 1031 exchange works. So what we have is this person who has this this multifamily, and this is right over my stuff. And so that basically they have after they've closed escrow on the sale and they move the money to the exchange accommodator, there's 9 million in equity, 1 million in mortgage. So they have a highly appreciated asset. They had some existing depreciation that was about 40,000 per year, and it had been depreciating for 25 years. So since the depreciation schedule on a large investment property is a 39-year schedule, that means they have about 14 years left. All right. Now what they want to do is to buy a warehouse, and they're interested in buying a 50,000 square foot warehouse, and the price to purchase it is somewhere around 7.25 million. So what are we going to do? Well, we have something that's called a special DST. So this DST, what it does, it would allow you to basically get a 86% cash out for the sale of that of the money that basically went into escrow. So, or sorry, that went to the exchange accommodator. So the $9 million that went to the exchange accommodator, you would get 86% cash out, or 7,525,000. Now, the way this would work is when you close the 1031 exchange, the cash basically goes into the exchange accommodator, and then basically we would be doing the special DST. What this does is when you make the investment, within 1 month, you would get that 80%, 86% cash out. Now, this transaction would basically cover the debt and cover the equity, meaning that all of the requirements of the 1031 exchange are satisfied. And you're sitting there with basically 7.5 million cash. Now that cash is your money. You can do anything you want with it. You can go buy a car, you can go buy a house, you can, go to Reno, put it on black, do whatever you want. Now what this person wants to do is they want to buy a 50,000 square foot warehouse. So basically they're going to take 7.25 million to buy the warehouse, and that would leave them with 275,000 cash. Now, what they're doing next is basically, after we analyze this particular property, because it's a warehouse, it pretty easily qualifies for the 179D. So they're going to take $175,000 and put it into lighting and office insulation. They'll get, basically, they did it with the right contractors. They met the requirements, so they're getting the full $5.36 per square foot. Now, in warehouses, as some of you are probably aware, the biggest cost of running a warehouse is lighting. So the biggest energy consumption is actually the lighting for the warehouse. So changing it from fluorescent to LED would pretty easily help you hit that 25% energy reduction. So warehouses are like a sweet spot for the 179D. Now, they also decide to do solar panels, or I'm sorry, I forgot to mention that 50,000 square foot warehouse at 536 per square foot is going to give a $268,000 one-time tax deduction. So they also look at doing solar panels installation, minor roof work. They invest about 50,000 in the solar panels. They're able to qualify for some of the bonus tax credits, so they get a 40% tax credit against the 50,000 for a total tax credit of $20,000, or 40% of 50,000. And then they spend another 50,000 on a cost segregation study, and they get bonus depreciation for the next 7 years of $45,000.
Hey, Chris,
Yeah.
on this, on the 175, let's say the $175,000 that they spent on the LED lighting, that $175,000 is expensed in the same year as well, or is that usually capitalized into the cost of the building?
I'll show you that on the next page.
Because that gets, okay, perfect.
So basically, the 179D becomes a deduction. Now, in this particular case, they can't use the entire deduction in year one, so some of it's going to carry over to the next year. For the solar, it's a tax credit. They get that tax credit in the same tax year that they did the solar work. And the cost segregation study that 45,000 in bonus depreciation applies immediately to that tax year. So basically for this building, kind of the power of this solution is from a deduction perspective, they get to carry forward their existing deduction from the 1031 exchange. Because remember, they had 40,000 a year. They made an investment. That investment will carry forward the depreciation from the original asset from the 1031 exchange. So they're getting a 40,000 a year deduction for another 13 or 14 years based on their 39-year depreciation schedule. In addition, the original purchase was going to get, less the part that was accelerated, about 110,000 in depreciation anyway each year, plus the bonus depreciation of another 45,000 per year. So they're going to get 195,000 in depreciation. Now this warehouse is making about 75 cents a square foot. It's a pretty conservative number, for an area that has no state income tax. So they're making about 450,000 a year off of this building. When we basically subtract the depreciation and then we take as much of this one-time deduction as we can, without even counting their other business expenses, they essentially have taxable income of 0 in year 1. And on top of it, they're getting that $20,000 credit from the solar work. So they're actually net up from a tax perspective, $20,000 year 1. Year 2, we use up the rest of that depreciation from the 179D. And then we're looking, before other business expenses, we're looking at taxable 242,000. And then each year thereafter, taxable of 255,000. So hopefully what you can see from this example is that by basically stacking these solutions, we can get an immediate one-time pop, as well as basically reduce our taxable income quite significantly over a significant period of time. Now, if you're holding a building for, you're expecting to hold it for 30 years, you have to ask yourself if you want to accelerate the depreciation or not, because basically on the back end of that, you're going to get a lot less depreciation. Basically, these other things will drop off, and then you'll be left with 110,000. However, you'll have that for, for 39 and a half years. However, for most people, when they're buying a new building, I mean, that's when everything is kind of the highest stress in terms of income and expenses, and getting all these additional depreciation up front really increases your cash flow up front, gives you the opportunity to basically get the property matured and settled. And then as things go up in future years, you can handle it because most likely by then your income has also gone up.
Hey, Chris, I have a couple questions, buddy. First of all, this is an amazing way to stack these strategies. I saw somebody else mention that in the chat. Like, it gets really exciting, but you have to understand all the different tools in the tool belt, which is why you got somebody like Chris on your team or in your power team that you could reach out to, right? It's not these events aren't meant to give you every single answer in 30 minutes, guys. It's to make sure that you know that these things even exist, and the who to help you do the what, the who to help you do the how, and who to reach out to. So we shared Chris's information in the chat box too, so that way you guys have it. But Chris, when you say 1031 depreciation, I own a property and I sell it in year 2. I can take the depreciation from it for the next 37 years.
Yeah, well, it depends on how you invest it, but yes. So what happens is with the 1031 exchange,
on a property I don't even own anymore.
Yeah, so basically with the 1031 exchange, you have to carry forward the depreciation. So basically in this particular case, they bought this building for $2.5 million. It depreciated. They have basically, had $1 million worth of mortgage left and $9 million equity. Now they're buying a property that's worth less than $10 million. So, well, they actually bought a property they actually bought $10 million worth of real estate by using this strategy that I just spoke about.
Right.
Because they bought $10 million worth of real estate, they sold $10 million of real estate. They met the requirements of the 1031 exchange. However, that $10 million, you don't get to reset the depreciation to $10 million. You have to carry forward the original depreciation from the original property for the 1031 exchange. So in this case, they had a $40,000 a year depreciation from when they originally started. That carries forward with this 10 million through the 1031 exchange. Now, because in this particular case, you had a cash out strategy, you would continue to get that $40,000 a year depreciation from your original 1031 exchange, and then in addition get the new depreciation from the new building that you bought.
Mhm.
That's kind of the power of a cash out strategy. We actually have multiple different ways of doing these things, literally hundreds of ways. So we basically customize the strategy based on, what the asset do you have, um, uh, what your objective is and what you're trying to accomplish. So in this particular case, we help this particular apartment owner sell their highly appreciated asset and pay no tax. We help them buy their warehouse cash and pay no tax. We reset their depreciation schedule, plus we kept the original 1031 depreciation plus bonus depreciation, and then made tax efficient investments to help lower the income in the taxes. So we basically we customize strategies based on what it is you're trying to accomplish and based on what asset you have. So if you have a business, you can't use a 1031 exchange. We would do something completely different than if you have, a scenario like this one.
Now, when you say that when they sold their property, they paid no taxes, but with the Delaware Statutory Trust, they only got 86% of their money. So it's almost like there was a 14% tax.
Well, the
right?
14% that's remaining is actually invested in a Delaware statutory trust. It's a zero coupon, and it's this particular strategy. It's a 20-year investment. However, it's actually invested, which I think I forgot to mention, it's invested in an Amazon warehouse. So Amazon, from a business perspective, they had bought all their properties and then built their warehouses on them, which was great when they were starting out, but now they're not getting any tax benefit from owning that land and just paying, property taxes on these large tracts of land. So what they did is they worked with an investment company where they basically sold the land and the building to an investment company and then leased it back. So in this particular scenario, Amazon is actually paying the lease. The loan that you got back is basically against this property of that $86,000. The remaining 14% is still invested in the Amazon property, so it has a going concern. And then essentially over that 20 years, that property is going to grow in value. And so when it goes full cycle and sells, you will actually make appreciation off of that original $9 million investment, but it's 20 years out.
So on the $9 million that you took from the sale of your property, you put it into this, but you actually get 7.5 of it. So really only 1.4, 1.5 stays in this Amazon fulfillment center, correct?
Yep, exactly.
And then of that 1.5, let's say the property doubles over the next 20 years and you pay it down to zero. Let's say, I don't know what the equity split is or whatever, but that 1.5 million, whenever this Amazon fulfillment center sells in the future, could come back at $4.5 million or something.
Well, that's actually the interesting thing. You got a $9 million investment and you had a loan against it, right? So basically, let's say the property doubled. Well, now you've got 18 million in equity. You pay off the loan and then you're getting the rest of the equity out.
And you still got $7.5 million
Up
for
front,
this
right?
other deal. Got it. So the cash out is refi proceeds because you got a loan on this Amazon fulfillment center.
Right.
Got it.
The underlying instrument is a loan, but essentially it doesn't act like a loan because essentially Amazon's paying the loan payment.
Understood. Yep. Makes sense. Yeah.
Yeah, and if
That's
Amazon,
the
went belly up, these warehouses have enough steel in them, so if you just salvage the steel, it would be enough to get your money back.
Love it. Love it. Good stuff, man.
Oops. All right. Other questions on that strategy?
Open up the chat box over here. So the special Delaware Statutory Trust is existing already, or it gets created by your team, or
yeah, there
Chris,
is a
can you explain
provider
that a little bit
that
further?
it already exists. Basically it's currently against an Amazon warehouse. This company will do things against very stable tenants. So it'll either be state or federal government buildings, a company like Amazon's warehouse, something that's very core to somebody's business that's going to be around for 20 years.
Yeah, and so you're talking about, so what Chris does, he has other operators, right? He's got a few operating groups that utilize this strategy as one of their sole ways of raising capital.
Right.
And so he's already got them all lined up. So he knows that if somebody's selling their business or somebody's selling their piece of real estate and they need this, he helps kind of just connect the dots, and then it helps that owner operator. It helps you. It helps Chris's company because he's able to come in and help structure everything for you as well.
Yep, exactly. Yeah, so we work with, many different people, and over the last, 15 years, I forgot to mention up front. So, I am a real estate investor. I've, done 5 multi-million-dollar 1031 exchanges. I've owned a, $11.5 million building in San Jose, 85-unit apartment building. We're business owners, and in the process of just living life and doing investments, we learned a lot about paying taxes and how not to pay them. And so my business partner and I basically started our company to help people understand all of these solutions that most people don't know are even out there.
Hmm. We got a couple questions. How far back can somebody amend the returns to claim cost segregation savings? You said you can go back.
Well, what
3
I
years?
would like to say is that I'm not a CPA, so I'm not going to answer that question. This is where I would partner. Basically, if you're looking at your team, if you have any significant wealth, you probably have a team of people. You work with a realtor, work with an investment advisor, you work with CPA. What we do is we're tax strategists. So we'll come up with the strategies, and then what we would want to do is to work with you and your CPA to go figure out the details for your specific situation. Because the answer is it depends. And that's where we would want to get a CPA involved. Now, a lot of people will say, hey, my CTPA doesn't bring me tax strategies. Well, or you're saying, hey, I'm paying a lot in taxes, and they'll say, well, that's a good problem to have. Well, that might be a sign that you might be growing your CPA, or need somebody like myself who's a strategist who can give you those other strategies, right? Because it's not really the CPA's fault. And by the way, maybe, my experience, about 98 to 99% of the CPAs don't really get into a lot of the strategies because they're too busy, doing tax returns.
Mm-hmm.
The rare exception to that is somebody like Byron, who you will, see at the event, and I think they're speaking today too.
Mm-hmm.
Their team actually goes after these strategies and helps you find them. That's how we ran across each other.
Yep. Yep. So Eve, like you can file a cost segregation study at any time during your ownership of a property.
Yeah.
And that's what Chris was mentioning, is like, it just doesn't make sense to do it if you've owned the property for more than really like 7 years. And so, my mountain house, we bought it in 21. We just filed a cost seg in 23. And so, we did it 2 years after we bought the property, and, still made a lot of sense for us to do that. So you could do that. Can you go back and amend your returns? That's a CPA question.
Yeah.
And what does that look like? I'm not sure if you could do that though. So, but the good news is you could probably do it now.
Yep.
Yes, it will be recorded. Can the new owner you sold to then do their own cost seg and depreciate? Mark. Yep. They have a new basis for coming in and buying the property at $10 million, and then they can obviously cost seg it as well.
Right.
Chris asked, so the special Delaware Statutory Trust is existing already, or it was created by you or your team. It's already existing. This is already one of the best webinars I've been on the last year. Thank you. And then Byron said, hey, Chris, tell him when you need to do the study to take the deduction for 2024.
All right.
The cost seg
deduction for 2024
or 2023.
2023. Okay, so it can't go back.
Cannot go back.
No, it can. Byron
Okay.
just said take it for 2023.
Yeah. So from my understanding, you have to initiate the cost segregation. It doesn't have to be done in 2023, but you have to like initiate it for 2023, and then you could file it still whenever you file your 2023 taxes, right?
Yeah, I can't answer that. I have a license as an investment advisor. There's some questions I can't answer.
All right. So Byron chimed in. He says you have to do the study by the filing of the tax return for the year. So, Byron, I think that means if you're filing your 2023 taxes, it has to be done prior to when you file your 2023 taxes in 2024.
Which sounds right.
That's correct. All right, cool. Fantastic. What are the questions you guys have for Chris? Are there books? Are there resources, your website, like webinars, or I mean, obviously stuff like this, but YouTube videos or anything else that people could plug into in order to learn a little bit more about these things?
Yeah. So at a high level, our website is defertax.com. We do have some information there. We're in the process of reforming our website. So as soon as that goes live, there will be a lot more information, but that probably won't happen until early next month. We're also in the process of putting together a class. It's like $20 a month. We call it Deferred Tax University. And basically we would do webinars like this. And none of this is live yet, but essentially the intention is to go live next month. So we would actually have additional information that you can drill into around all of these different strategies, but it's not available yet.
Cool. Cool. I love it, man. What other questions you guys have? Any other questions? Head spinning? Still trying to digest it all? Chris, what's your contact info? What do you think? The website's the best place for them to hop on and then just inquire for more information?
So if you go to deferredtax.com/contact, basically, we respond to those. You can either set up an appointment or, send us an email. Be happy to follow up. Or you can also send an email to me. I'll give it to you guys. It's chris@deferredtax.com.
Yeah, if you can just put it in the chat box to everyone, that would be helpful. Yep.
Just mention Tim in the email.
Yeah, I don't get anything out of it, right? But you can know where you met Chris through, and so that way he knows. Yep. But yeah, I bring on the best because these are the people that I'm talking to on a daily basis about doing this kind of stuff, guys. And you got to go through the reps, and a lot of times you don't even know that this stuff exists unless you are found in this situation, and somebody usually tells you after the fact, hey, you could have done this, you could have done that. And I think it's really important to try to stay ahead of it and make sure that you understand that these things exist. Now you know who to go to whenever you're going to have any sort of big capital event that occurs, and make sure you're just having the conversation. Get on the phone, call Chris. He's happy to talk with you, offer some ideas and insights and strategy around it. And it pays for their services pay for themselves many times over by helping you with all the tax savings.
We love basically just educating people, and it's just like you said, so many people don't know what their options are, and it's just crazy because we're talking people leaving millions on the table because they just didn't know.
When's the best time that somebody should be reaching out to you? When they acquire a property, when they put it under contract, before it's under contract?
Yeah, ideally we would talk, if you were in a sale scenario, ideally it would be at least a month before close. So we have time to basically react, because it takes time to kind of absorb the information and understand what the options are. So ideally a month or more before you're actually going to close an escrow. We can do something as quickly as a week, but typically those don't go through because you just don't have time to really kind of internalize the options, right?
Mm-hmm. And so are there things that need to go into the contract that when you're looking to sell that need to be in the purchase and sale agreement in order to capitalize on any of these things? Or that doesn't really, that was my question.
Yeah, it depends on what your goal is and what you're trying to accomplish and which strategy we use. Sometimes there are, and basically the bigger the sale, the further out in advance you want to get, because what you don't want to do is to change your purchase and sales agreement late in the process, and then the guy uses it as a reason to back out.
Yeah. So back out or retrade on terms or whatever.
Yeah, because once you open the door to terms, they go, okay, then
he needs this. Yeah.
Yeah, especially if you're in a 1031 exchange. And of course, you have to open your 1031 exchange before the close of escrow.
Right.
I've done it as quickly as 1 hour before the close of escrow, but ideally you're at least a week out.
Mm-hmm. Good stuff. Can we show Chris some love in the chat box? Say thank you. Chris, really appreciate it, man. Super insightful and really gets the wheels turning on what's available. So I'm excited to see you in a couple of weeks in New Orleans, man.
Yeah, I look forward to it. Well, thank you all.
All right. Thank you. Good stuff. So now we are going to pivot over to tax strategy. If your head's not spinning enough already, we're just getting started, guys. That's one of three. And so now I'd love to introduce Melanie and Byron. They are absolute all-stars at what they do on the tax strategy side of things. And I've been working with them. They're members of Legacy Family. We've done podcasts together. I've had them on a couple of the other Legacy virtual trainings and put them up on stage at Legacy Family because there's so much value and so much insight into what they know on the tax strategy side. As you're growing your portfolios, you're dealing with bigger numbers. You got to understand how this stuff works to make sure that you're just I mean, your biggest expense in life is going to be taxes. So understanding how it works, how the tax code is written, how it's written to benefit business owners and landlords like us. And if you're not using it, it's your own fault, right? It's out there for us to be able to utilize it. And Melanie and Byron are some of the best across the entire country at what they do. So what I'll do is let me hand it over to you guys. I know you're gonna have a ton of insights, and so go ahead and take it away.
All right, I'm going to share my screen here. And let's go here. All right, go to slideshow. Can you guys see this?
Yep, looking good.
All righty. So like Tim said, you're not allowed to say free money, but we're going to teach you how to unlock hidden wealth and taxes. All right, so just a little fun thing. What do all these pictures have in common? Feel free to throw it in the chat. This is we're ziplining in Hawaii, people cheersing drinks. We got my kids in Hawaii here riding on a camel, college, graduate. These are it's an orphanage in Africa that I help, and then a nice car. We got a duplex, and my dad, his mom, and our family here. So just a little hint, they were all paid for with tax planning. So dollars can unlock a lot, tax planning can unlock a lot of just hidden treasures in your life. And it's not necessarily just dollars, but it's what those dollars can get you. So the problem is though, is that the bulk of, like Tim said, the bulk of people's money and their income is going to go towards taxes. My dad looked up the spending habits of somebody that's making $200,000. And we plug that in. If they were self-employed, we plug that into our tax software. 42% of their income will go to taxes. So that's a huge chunk of the pie. And what you don't see is that what's left for wealth accumulation is only nothing. It's actually a negative $867. They're going into debt, the average person. And so you look at the spending habits of people, it makes sense. And what you don't see also is they have vacations, they have fun things. A lot of people aren't willing to sacrifice those things to be able to build their wealth. And so the solution to that is tax planning. That this guy, we were able to plug that into our tax software with some of our strategies that we're going to teach you today. And we're able to find an extra $53,000, almost $54,000 to be able to put towards wealth accumulation. This whole slice of the pie was able to be created just by tax planning. It gives you an opportunity to grow your wealth, but not have to sacrifice as much. There might be still some things that you want to sacrifice to make it come faster, but you can build your wealth without increasing your income, without reducing your expenses, having to get another job and, be super frugal and cheap. And also, if you're somebody that's like giving, it allows you to still give maybe while you're building your wealth. So it just rapidly increases that process of getting what you want later in life if you strategically tax plan. So the $1 million question is, how do we find that cash? Some of you guys from Legacy might have already heard some of these strategies, but I think it'll be repackaged in a way that will hopefully help you see it differently as well. So we're going to talk about our 8-step tax solution. We're going to show you real life stories of our clients that have been impacted by these and how they were able to build their wealth just by utilizing some creative tax strategies. So let's jump into it. So Jim, we're going to use, these are real people, but we created fake names just because as a CPA, we're not allowed to share details of clients. And so we repackaged their name, but the stories are very real. So he was a realtor in Texas. And when he came to us, he had an S corporation. He was netting $250,000 a year. And so it seemed like he was making a good amount. He had a child who was attending Arizona State, and since he was Texas, he was paying out-of-state tuition, which, is a pretty hefty amount. He had 2 kids that were under the age of 18. And with all of that, plus his taxes, he had no money left that he had saved for his kids' college. He had a mother that he needed financial help, so he was feeling pretty stretched then. Before us, we said he was doing the ostrich plan where he stuck his head in the ground and hoped for the best. He had a CPA who, like Chris said, was saying, hey, you're making a lot of money. Good job. If you're paying taxes, it means you're making good money. And he felt like he was bringing all the strategies to his CPA, whereas CPA he didn't feel like his CPA had his back. For his daughter's college, his plan was just to borrow, go into debt an extreme amount, especially with the out-of-state tuition, and pay it off over his entire life. So that was the plan before that. Not a very good one, if you ask me. So what we did is we utilized a few of our strategies from our 8-step solution. We had the ebb tide plan. This is where he utilized his mom's and his daughter's lower tax brackets. We were able to form a corporation in Arizona where his daughter was going to school and actually get her in-state tuition as well. And so we just creatively utilized their lower tax brackets. For him, it saved tax on $40,000, but there was a lot of room to grow in that. And so we were able to, you know, have wiggle room to be able to save him more as his business grew over the years as well. The Augusta strategy, you guys may have heard this one. It's where you can rent your house for 14 days tax-free. With that, we taught him how to do this, and we're able to save tax on $14,000. And then the kids' payroll, this is another very well utilized one, or really well known one, but not well utilized, I'll say. It saved tax on $25,900. This is where you can hire your kids. For this year, it's $14,600 tax-free. And so, like, here's my daughter. I use her for my little model there, and you can make some tax-free income that way. I'll put a little tip in there. A lot of people know about this strategy, but they don't know how to set it up properly. So if you have an S corporation, a lot of people just pay their kids from the S corporation. What you want to do is pay yourself as a sole proprietor and then hire your kids through that. Then you don't have to pay payroll taxes. So that saves an additional about $2,000 per kid. With Jim, we also reduced his wage. He was paying himself $120,000, and we reduced that to $60,000. He was able to save save payroll taxes on $60,000. So that's 15% of that. And then he also got what's a QBI deduction of $12,000. So what QBI is you get an additional 20% deduction right off the top for putting money in your net profit as a business owner. And so we were able to shift some of that money out of the payroll into the QBI and get an extra $12,000 in deductions there. And total savings for him was $43,000 a year. And that didn't even include the in-state tuition. So I looked it up, and in-state tuition is an additional $15,000 to $20,000 a year. And so that was a huge amount of savings right there. Plus, every time he visits his daughter, vice versa, they're able to write that off as well. So that doesn't even include that in the $43,000 savings. So what he did with that, he borrowed, he still decided to take the parent loan and leverage that so that he wanted to put 50% of the money he saved into, you might have heard about the cash value life insurance plan. The key here for tax strategy is that it's properly structured. And so he was able to leverage that loan, plug that into the cash value life insurance policy. And then once his daughter graduated school, he borrowed against that and was able to pay off the loans very quickly. And so he was able to build a tax-free growth vehicle with his tax savings. He was able to finance his kids' school and help his mother and not go into debt and not eat into his lifestyle as well. So that's the huge impact of this. He was not only able to do that, but he was also able to build some tax-free retirement income. He had a $1 million death benefit and a little over $900,000 of cash value left over after he paid off his daughter's school. So very cool. Moral of the story is your tax professional should be a profit center for you, not a cost center. What Chris said about CPAs and tax professionals is very true in the fact that they're busy. And it's not necessarily their fault, but to me, if you're having somebody do your taxes, they should also have your back and ask you questions to save you money and not just fill out the forms. And so that's the moral of the story here, making sure whoever you're working with to do your taxes should also be a profit center for you and make the money back well above what you're paying them. All right, Tim, I think you'll like this. So Robert McKnight talks about the 3 buckets that people hold their money in his book, The Power of Zero. There's a tax now bucket, which basically your money is just going away. Tax deferred bucket. Here's Tim here taking it. It's almost like a loan. Bonus depreciation, cost seg studies, all that is a good example of this because you're taking that money and you're going to utilize it to grow your portfolio. And then here's Tim here just throwing the money around because it's tax free. That's the best bucket to be in. So we prefer tax deferred or tax free. Tax free is the best if you can do that. So Jim was a prime example of taking money that was just throwing away to the IRS, and we're able to put that into his tax-free bucket. All right, Dad, I'm gonna let my dad share about Mr. Juan here.
Okay. One was a client of mine that came to me about in 2010. And when I met him, he was doing really, really well. He was having a net of $5 million. He was going to owe about $2 million in tax, which really was all the money that he had left over, you know, because he needed to keep working capital, keep the machine going. And the thing is what he really wanted to do was invest in real estate. And the by having to pay all these taxes, it was going to totally deplete his cash flow and then stop him from investing in real estate, which is his true passion. Okay. Next slide, Mel. Okay. So what Juan was doing before me was what a lot of business owners do. You know, he was basically invoicing his clients, and then he was voiding the check, collecting the money, then he was holding the checks till January. And then basically would re-invoice the clients, you know, which basically he was committing fraud, which a lot of people do unintentionally, but they're, well, maybe not unintentionally, but that's what they do. So what I did to motivate Juan is I pulled up several court cases, showed him where people had gone to jail for much less than he had done, and basically showed him how there was legal ways to do it. So what we did is we implemented our kick the can strategy, which is a big deferral program, and we actually got his income down to $250,000, and then it basically gave him what got his tax down to $250,000. So we basically got him a $1.7 million courtesy of the IRS and the governments. This was California, so the taxes were all higher, but it basically got him that much money to be able to invest in real estate and keep the working capital, keep this cash machine flowing that was his business. And that was just in year one. In subsequent years, he qualified for a total deferral of 15 million, which over several years got him 7.5 million in deferred tax. And he used that to buy real estate starting in 2010. And then what happened is I met with him the other day, and his real estate collection was up to about $24 million. Now, and Juan's a good businessman, so a lot of that's on him, but basically he used all of the tax deferral money, and we saved him some other money too, but it basically equated to getting that money from the IRS. It was really a 0.11% interest loan from the government that he got. Now, one thing I want to make perfectly clear, he does still owe the money, and now he's paying it back, but he's paying it back with, you know, and he still has all the real estate assets.
We wound it down though, Dad, to 2 million, right? It's close to 2 million now. Didn't you say that the other day?
The what now?
The deferral, isn't it wound down to 2 million instead of 7.5?
Yeah, he only owes about 2 million still out of the 7.5. He's been paying it down. What happened? Well, what happened in his business is when you get over 25 million, you have to switch to accrual basis, and you can no longer do this plan. So you have to pay the money back over a 4-year period. So he still has the real estate and has the tax liabilities paid down. He only owes 2 more million. And, you know, it's really just made him a fortune on it. Briefly, bam. Briefly, what I tell you on the kick the can plan is what we basically do is we form a separate company with a different fiscal year in, and we teach you how to cycle the money through and basically create tax deductions. And someone with $1 million can actually get a $2.8 million tax deduction with very little cash. You have to have a little cash to lubricate the system, but it doesn't take a lot of cash. And this way you're using your own money, and it's just cycling it based upon the different fiscal year ends. So it's a pretty lucrative system. And the moral of the story on this is, you know, Juan was actually, when I was talking to him, I said, you know, what would be the effect if you got audited and got caught on this and had to go to jail? What would that do to your family? What would that do to your business? And there's basically legal ways out there to reduce or delay the taxes. And so you don't have to risk everything you've worked for to get those taxes down to a reasonable amount.
Mm-hmm. All right, the buckets here, we went from tax now to tax deferred. He was able to use that to grow his portfolio, pay it back, and leverage those dollars that he would have just thrown to the IRS. What we don't really have a ton of time to go over these, and some of these are what Chris went over too, but there's a couple extra ones as well. But we call these our hangover pill strategies. What I wanted to do is throw it your way. So if you do have a large sale, probably $200,000 or over, just make sure that you know
Large gain.
gains. Yeah, sorry. Large gain of over 200,000 or more. There's options out there to minimize your tax burden. We call them our hangover pills because they're your cure to the pain of capital gains. But we have before the listing, after the sale, we have different options. The key here is talk sooner than later, come to us sooner than later. Do not tell us after the fact. That's when you have the, oh, you did conversation. And so just the more proactive you can be, the more proactive we can be as well. So circling back, you look at somebody that's making $200,000 and you have this big chunk of the pie, making sure that you are doing tax planning, how we are able to open up that $53,000. Which one's better? It's the key is just to make sure you're planning with your CPA, planning with your tax professional, making sure they have your back. They're asking you questions that you're not even aware of. And so it's just think about what would you do with an extra $54,000? Would you, how much would that impact your portfolio and how much would that impact your future wealth? So we always offer a second opinion. It's a free tax assessment. We always offer, we just say if you are getting some work done on your house or anything, everybody gets different quotes. If you have a health diagnosis, everybody gets a second opinion, but it's with the biggest chunk of pie out of their financial portfolio that where your money, majority of your money goes to over your lifetime, people don't get a second opinion. And so we just wanted to offer that today. If you have questions, we can open it up for Q&A right now. We could even jump back to the slides if you guys like, but here's some information if you guys want to get a hold of us. I try to do a lot of tax tips on Instagram and just try to give out as much value as possible, but feel free to scan that if you'd like to.
And we also have a course in Tim's library if you want to read up on a lot of this stuff.
Mm-hmm.
There's a lot of extra tips in that.
Good stuff. Good stuff. I love hearing you guys talk about this stuff. Like it gets so exciting for me, and you guys make it so much fun too. Like all the different names and the goofy quirks and stuff. And what I can say is, listen, guys, I've had probably 6 different CPAs in my real estate investing career, and whatever it's been, 15 years. No, it's been longer than that. 19 years now, and I know who the best of the best are, right? Like I've been through all the bad CPAs in order to find good CPAs. And you don't have to go through all the bad ones. Like a CPA is an asset to your team. And by the way, I get nothing from this other than supporting amazing members of our legacy family community. But reach out to these guys, like have them. It'll pay for itself many times over if you have somebody who's competent, who's has the CPA and the tax strategy ideology here behind you. They can really get creative on some things. And yeah, I mean, they've audited my stuff and looked at it and said, hey, you need to be doing this, and this, and have made some big changes because of that. So what kind of questions do you guys have on the tax strategy side? Hopefully this stirred up some ideas and stirred up some thoughts on things that you could be doing in order to reduce your tax liability. But what kind of questions do you guys have? Put them in the chat box.
Mm-hmm.
We got some time. Kind of left it open for some Q&A for about 10 minutes.
I was going to tell people that if they want, we have 2 white papers, one for the Augusta rule and one for kids payroll. If they want to text Augusta rule or kids payroll to that 924 number, we can send that out to them as well.
Yeah, let's talk a little bit about those as well, right? The Augusta rule, maybe give some background on it. It's for the masters, right? All these people in Augusta would end up renting out their house for the masters for these big numbers for a couple of weeks every April, right? And then they essentially got it passed into law where there's a deduction where you can rent out your own house for a retail price, and it's non-taxable income. So talk a little bit about like what that strategy could look like.
Yeah, so what we do is we have a lot of our clients just hold their corporate board meetings in their home. So, a lot of business owners are at home. They do stuff, they're always talking business or thinking about business. So we just teach our clients how to basically put that on paper so that it holds up legit. So you can write a check from your business account to your personal, and then you just write up minutes for the meetings that you held, and then an agenda item, an agenda list, and that would basically legitimatize it. Dad, anything to add to that?
Yeah, there was actually a court case on the Augusta rule where you had two shareholders in a corporation. That's actually three, and they all did the Augusta rule. And it was great because some of the people, it flew in flying colors. Some of the people got rejected, and some of the people got partially rejected. And what they want to see is, one, you're paying a reasonable amount. So if you're paying $10,000 for a daily rental of a $500,000 home, that's probably not reasonable. So one of the things you need to do is do a little bit of research on what your home would rent out for, with Airbnb or whatever it would. But what's a reasonable rate of rent? And then the IRS also wants to know, show me that the meetings actually took place. So we always tell people it's very beneficial, one, to schedule these meetings on your Outlook calendar or good Gmail calendar, but put them on the calendar. And then one thing we do with people is teach them how to fill out minutes for these meetings. So that way you have documentation that the meeting happened, and you got to write a check for it. A lot of people want to write the check all at the end of the year or reclassify their distributions, but by writing a check and doing it timely through the whole year, it really passes a lot more muster. So it's reasonable amounts, have the meetings, and be able to document it.
So so what that does is it takes your business, let's say you make $500,000 a year, $200,000 a year, and your house can rent for $500 a day. If you had a board meeting once a month in your house, now all of a sudden you have a $6,000 check that your business writes to you personally, and it's not taxable to you personally, but it's still a deduction for your business.
Yep.
That's correct. And what we like to do is just set these up as memorized transfers. That way the checks are all written by the end of the year. You don't forget. And in someone like in a high tax state like California, you're saving 50% of that money. I personally rent my house for about $1,000 a day. California, you get more expensive houses, so you save more on this. But I get $14,000 a year tax free just for shuffling funds and obviously doing the minutes. So it's just a great, easy, low-lying fruit. There's a couple tricks that you got to make sure you have to have a separate office. You can't have it be your only office, only place of business. And it really works for any home, and so you can actually use it for vacation homes too.
So it doesn't have to be your primary residence then.
Yeah.
Awesome.
The main thing is not having like 1,000 meetings. So if you have multiple homes, multiple partners, having 30 meetings throughout the year, is that reasonable? It might be. Just make sure you can justify it.
Yeah. But you can only do it for 14 days a year, right?
Yeah. Per house.
Per home.
Per home. I didn't know that. I didn't know that was a caveat. It's good to know.
Yeah.
I have a lot of meetings.
I'm sure you do.
Yeah, I do. I literally do. No, that's fantastic. So let's pivot a little bit over to the paying your kids as well.
Yeah.
So especially if they're under working age or whatever, right? I have a 1-year-old, a 6-year-old, and an 8-year-old. But they can be models. They participate on a bunch of my social media stuff. I utilize them for the kids' books that we have. I put my daughter up on stage once in a while and ask her questions about all sorts of different things. And I'm going to be actually actively building a brand around her. We're going to go start buying some houses in her, in like a trust that she controls and stuff like that. And so that can really obviously it legitimizes, but
probably pay her more than because it's just reasonable pay for reasonable work. So it has to be justifiable. You have definite justification around that.
And so what that does is similarly, it takes my higher tax bracket, pays it to my daughter at a lower tax bracket. And if you're under, I don't even know what the numbers and thresholds are, but it's 20,000 or 50,000 or 25,000. There's like 0 tax or 10% tax return. So you're essentially reclassifying your tax bracket. So instead of being at 37% over here, now we're at 10% over here by paying the kids, right?
Yeah, so you get up to the standard deduction, tax-free, so 14,600 for 2024. And then anything above that would just be taxed at a much lower rate.
But
And then-
there's self-employment income as well if they're not on W-2 payroll, or how does that work?
Dad, you can answer that one.
Well, if you don't want to pay them as 1099, because then you do have self-employment tax, but
Right.
if you pay them as a parent, not as a S corporation, there's no payroll taxes on it. So they just get it, the money goes at 14.6, it just goes straight to them and there's no taxes taken out. So the best way is to pay them as a parent, or a single member LLC works too.
Okay.
He makes like a sole proprietor, so
Yeah,
just like
sole proprietor.
1099 yourself, and then from that 1099 you W-2 your kids.
But there's no, I'm sorry, I would W-2 my kids.
Yeah,
Right.
from
There's,
your
yeah,
sole
there's no
proprietor.
payroll taxes on it.
Oh, but there's no payroll taxes.
Yeah.
No.
And then from there, you can have them do a Roth IRA, traditional IRA, whatever you want to. So that works.
Yeah, I mean
really
that's
well
what
to
we
build up a
typically do.
Roth.
We take all the earned income, we roll it into a Roth IRA,
Mhm.
and then let it roll.
Yeah,
So-
that's a great way to build their wealth too. And then jumping into the ebb tide plan, Dad, you want to tell them what you do with Grandma, just so I know.
Yeah,
some
my
people-
mom's 91 years old. She's still pretty sharp. She still does the bookkeeping for her church at 91. So, but I basically formed an entity. It provides a service to my CPA firm. Now, mom's just a passive owner. She doesn't do anything for it. She just owns the company. And I took a deduction of 84,000 for services. She picked up that 84,000, and the tax on that for her was actually worked out to be about 11,000. But I saved, because we're California and we got to pay our all of our lovely California stuff. I saved 41,000, but she paid 11, so I saved a net of 30,000 bucks. And I give my mom money anyway, so she just takes the money that I give her out of that corporation, and that way, and then she gives back the money to me, the extra. She does a gift every year to me.
So he makes a profit on helping his mom out.
I'm the good son, and get to make a profit on mom. So don't get
I
no
love
better
it,
than
man.
that.
I love it. And have you looked at doing like a legacy self-directed IRA with her at all, where you open up I mean, if you're over the age of, I don't know,
Yeah,
55,
she's
60.
91. Her required distributions would be almost the whole thing every year.
Yeah, exactly. But if you can make enough money in there, hey, that's all tax-free money. If you're
And
doing
then,
it.
and keep in mind that ebb tide plan, there's a lot of different uses for it. We have what we call the baby mama plan. For all the fornicators out there, you basically have a significant other that you either, they're in a lower tax bracket, they're living with you, you just put income into their name and it gets taxed at their rate instead of yours. We do this for college kids because they're always in a low tax bracket, and it's actually a way to make college education tax deductible. So there's just a lot of different strategies, special needs people, anybody around you, you ought to examine who's around you that's in a lower tax bracket. But parents, kids, and a lot of kids get out of school, they don't make any money for a few years. You can even do it after they graduate college. So there's just a lot of easy ways to use these, and everybody's a little bit different.
Chris,
Yeah,
you can use a brother as long as
you can use a brother.
As long as you trust him enough.
Yeah, you have to
I love
trust them
that.
to give you the money back.
Yeah, I love that out-of-state tuition, and then starting a business and creating in-state domicile, right? And then getting in-state tuition. That's
Well, then a real hidden treasure on that is when your child comes home, and then when you go see them, you're going to see a vendor or a customer. So it just makes all the meals, travel, lodging, everything's tax deductible.
Yep.
So that making as much of your lifestyle, it's all about moving stuff from the fully taxable bucket to the tax-free bucket as much as possible.
I would tell my dad for years, like, hey, you just need to buy a condo in Charleston. So every time you come back and forth and get a flight or drive or whatever, then it's a tax deduction for you, right? Like now you own stuff down in South Carolina, and now the travel is tax deductible,
Right.
and this and that, and all the other things. So, no, 100%. And I mean, that's why I bought houses down at Disney. We were going to Disney every single year, a couple times a year
Yeah.
when my kids were super young, and bought some houses down there. And guess what? Now I have an investment property. Now I'm going to check on my investment property, and there's a lot of great insights on or strategies that you can use there. So good stuff. Can we show them some love in the chat box, y'all? And by the way, Byron and Melly are doing a tax strategy session and really looking at profit and loss statements, teaching us all how to refine and trim the fat from our P&Ls and how to become more profitable and increase margin in our business. So they're doing an unbelievable kind of workshop at the Legacy Summit in New Orleans in a couple of weeks. Chris Shakowitz going to be there speaking as well. And so we haven't done this in the past, but we're opening up the Legacy Summit for anybody who wants to come out and just test out Legacy Family and get a feel for it. Test it before you invest in it, kind of a thing, right? Try it before you buy it. And the tickets are $2,975, and you can come there. It takes care of all your meals. You got to get there and get your hotel, but otherwise, social activities, everything else is included, and you get to be with rock stars like this. And if you can't make an ROI on that investment, you're doing something wrong, because the insights and the relationships in that room are just over the top. They're the best in the country. So
I'll give a shout out. I'm a part of several masterminds, and Tim and his team does such a good job at their events, at the Legacy Family events. I love being a part of this group. It's such a fun group. You guys, we have so much fun. And then we just really, the business does really grow just by being around all these people, the networking, all that. So I would highly, highly recommend. It's been one of my favorite groups to be a part of. So just throwing
awesome.
that.
I
Yeah,
appreciate you.
You become who you hang out with.
Mm-hmm.
And a lot of the people at Tim's place have several hundred doors. So if you want to become that, it's a great place to go hang out.
Yeah, it's not the newbie crowd, right? It's people who are actually doing some big stuff and talking big numbers, and through just osmosis of being in the room, you're going to fall into deals, opportunities, partnerships, joint ventures, tax strategies, and understanding what people are talking about and thinking about at that higher level. So now I appreciate you guys, and super excited to see you guys in person in 2 weeks. So thank you so much for being here.
Thanks for having us. See you guys.
Thank you.
All right, now we're going to keep the show going. We got Adam Maggio is I can't see the whole screen, but I see Mark Evans is on. Adam Maggio is hopping on as well, talking all about self-employment tax credits. So this is something that they've the government has had in the, I mean, I don't know the exact names of it. That's why we have Adam on, right? Explaining what all that stuff is. But with all the, are you here, bud? There you are. Yeah, but without all the money that was printed from COVID, there's this huge tranche, this huge treasure chest of cash that's supposed to be going to source self-employed people, and self-employed people don't even know that this exists. So if you have a team of sales people that are 1099, if you have a team of realtors, right? You have a brokerage, you have a team of insurance agents going out, you have a team of whatever that you 1099, your staff needs to know about this. Or if you yourself are 1099, you need to be knowing about this too, because it's tens of thousands of dollars per individual that could be accessible here. And it's not a bunch of hoops to jump through. It's not a bunch of, deferral on the timeline or anything like that. There's some really, really great benefits to it. And Adam, Mark, appreciate you guys being here. I would love to hear a little bit more about this and learn more about the tax credits.
No problem. What's going on, guys? Hope everybody is doing well. I appreciate him giving us some time here today to talk to you guys about some tax credits that are either available to you and or people that you may deal with in the real estate niche. And I just want to start off by letting you know a little bit about our company. Our company is called Orca Financial. We actually helped over the last 2 years about 20,000 businesses get roughly $2 billion in COVID relief funds to them. And what happened was we were looking for something that was available for the self-employed individual, right? There's always stuff out there for the big companies, and there's always tax breaks and things like that. But what we came across, and just to give you a little bit of a background on it, when the pandemic hit, right, obviously it decimated a lot of businesses out there, right? Whether you were self-employed or whether you had a full-blown office, everything changed at that moment, right? And a lot of you, you had, all of a sudden your children had to go home from school. You were stuck watching them. You were stuck maybe isolating during COVID, getting COVID tests done, taking care of COVID family members that were down with COVID. And what we did was over the last 2 years, we worked strictly with businesses, right? And what we found was the government had set aside a lot of money. And a lot of money is an understatement. A lot of you have probably heard of the PPP loan, right? EIDL, which was a little bit less known. And then the last one that was standing was the employee retention credit. And again, through the last 2 years, we've helped nearly 20,000 businesses and recovered about $2 billion in credit. So what we found was through our due diligence was there was actually a credit that I'm going to explain to you today that's meant for self-employed individuals. Now, some of you may even be employees and also have a side income, right? That would determine that you are eligible. All we need to know, and I'm going to show you kind of the flow of how everything works, was in 2019, 2020, or 2021. If any of these scenarios happened for you, you potentially could be eligible for up to $32,000, $32,200, right, in a check directly from the government. And I want to give you a couple dates to write down because time is of importance here. This is a use it or lose it, meaning that if you do not claim the money, you lose the money, right? And this is not a loan. It's not a refund of taxes you already paid, and the money is not even taxable. So what is it actually called? And I'll show you my screen here in a minute just to give you a little bit of verification on the IRS's website, as well as the actual platform that we have you go through when we decide to determine how you're eligible. So what it actually falls underneath is something called the FFCRA, right? And that's really a terminology for the Families First Coronavirus Response Act. And what it did was it helped independent business owners, sole proprietors, consultants, freelancers, 1099, gig workers receive money for not being able to work during COVID. Now, a lot of you, COVID's been such a long period of time, right? A lot of you kind of forget, and even our business owner clients forgot kind of the necessary changes they had to make. So the important deadline to know is this. April 15th of 2024, you need to file for this or you're going to lose 46% of your eligible money, okay? Again, to reiterate that, as of April 15th, if you do not start filing for this, okay, you will lose 46% of that eligible money. Now, again, it's up to $32,200. How it's determined is based on the amount of money you were making and the amount of days you were out. Now, there's a lot of different scenarios that will qualify or disqualify you. The beautiful part about this is we do this all through technology, okay? We have an form that you're going to go ahead and fill out. And basically, it's just going to ask you some questions, right? It's going to like that comply with government or quarantine or isolation orders, right? Were you symptomatic or sick? Not that you even had a COVID test, right? But were you symptomatic or sick during COVID? Did you have to go or have any side effects on the vaccinations, right? Did you have to take care of a child, spouse, or family member that was sick during COVID? Maybe the schools, and this is a one that a lot of our clients actually do, right? Is the schools shut down and now all of a sudden you were forced to change how you operated and you were staying at home to take care of those children while they were actually going ahead and attending remote sessions for school. Again, school could have been canceled, remote learning. And, if you helped a family member, a spouse, so forth and so on, and you filed, here's the key to it. You filed a Schedule SE, okay? That's what they look for. Did you file a Schedule SE? Now, some of you may have not, okay? Some of you may have not, and that's a good thing, right? So did you file a Schedule SE? Because filing a Schedule SE is what triggers this check to you, okay? Again, this is money directly set aside by the government, where with the money that was set aside for business owners, it was in a neighborhood of about $900 billion. Well, I want you to imagine a pot of money that's sitting there, that's roughly $50 billion that's set aside to, again, help gig workers, help 1099s, help self-employed individuals. And it's not only for you. What we find is that a lot of our clients, right, it's their spouse as well, right? So to kind of make it as easy as possible, what we have done is we have partnered with the IRS through our software, right? And our software is basically essentially an algorithm that runs in the background, right? You're going to go ahead and you're going to answer some questions, and you're going to identify the days that you were out and under any of those conditions. And then what's going to happen is, because we're an official software provider with the IRS, we are going to go ahead and we are going to ping the IRS through an API and grab your Schedule SE. So we don't even require you to actually do the legwork. So you'll enter your information, you'll go ahead, the IRS is going to get pinged to say, pass over the Schedule SE. And then in the background, we have obviously CPAs, accountants, and things like that that go ahead and review this. And what they'll do is they'll come back and say, here's what you actually qualify for based on this Schedule SE, and you verifying the dates that you were out. I almost want you to think of it like when you go ahead and book a vacation where you click days that you want to stay. It's the same process here, right? And then the third part of that is you're going to get a notice to say you are eligible or you are ineligible for it. And if you're eligible for it, we're going to give you the exact amount. Now, what happens at that point is this, and keep in mind, I want you to think about that, the amount of people that qualify. All right. Right now, the IRS says about 16 million individuals qualify for this credit, yet only 10% have even been educated on it. And a lot of times it's not because the accountant's trying to not do it, right? But it's a very specific tax credit that has a lot of paperwork behind it. So a lot of the people that actually team up with us, right, are accountants, because they don't want to spend their time and do it. They want to do it through an automated process. So what you have right now is you have the ability to go ahead, enter information, and I'll give everybody the website when we're done here, to go ahead and find out if you qualify. Now, just to be, just to be upfront with you, although I tell you it's up to $32,200 per individual, and if your spouse is a 1099 as well and filed a Schedule SE, they're eligible as well. What we find is the average claim is roughly about $10,000 to $12,000, right? So I don't want you, thinking that everybody's going to qualify for $32,200. The average claim is somewhere in the neighborhood of $10,000 to $12,000. Now, unlike other vendors, okay, because we're not the only vendor that does this, we do not charge any percentage of the money that you get, right? There's a lot of people out there, look, there's good actors and bad actors, as you all know, right? We're business people. So what happens is we just do a flat fee, okay? Once you get notice of how much you're eligible for, you can then decide. We'll do all the work beforehand, okay? We'll get the letter from the IRS. We'll go ahead and do the qualifications. Then and only then you can decide if you want to move forward. If you want to move forward, it's a $19.95 fee. So it's $1,995. So what does that do? That ensures that your credits are filed correctly. And that ensures that you're not overpaying, because if you're getting $32,200, sometimes, some of these companies want 20 to 30% of that money. We didn't think that was fair. So what we did is we decided on just basically charging a flat fee, regardless of how much you've gotten. Now, simple math will tell you, right? It's an ROI, right? It's a simple ROI. If on average $10,000 comes back, you're basically 5 to 1 on your money. Now, obviously, if there's a lot more coming back, it's even better. And quite honestly, we get people that are only getting 2 to 3 grand back that say, you know what, it's just not worth my time. But the key is that you just don't know, right, until you actually apply for this. And I don't ever like to be the type of individual that puts pressure on anybody. That's not the intent here. But time is of essence, because the way they calculate the credit is based on 2 years, right? Essentially 2020 and 2021. If you file for this past, okay, the April 15th deadline, you can still go ahead and try to qualify for it, but you're only going to be eligible to qualify for it based on 2021 and not 2020. Okay, does that make sense? So the important part here, and I commend, Tim for bringing us on here, because, there's not a lot of, and I've been to Tim's mastermind groups and I've had the opportunity to see, the next level of what he actually runs, right? And I think all of you know that. So for Tim to bring us on here and kind of want to communicate this to not only his audience, but maybe his indirect audience, about being able to bring this thing up to other people that you may work with, it really, it helps solidify a lot of things. We have a lot of what we call affiliates, and we have Fortune 500 companies that roll this out to their independent insurance sales force. So again, if you think you fit the box, what I'm going to encourage you to do, right, is at least see if you qualify. And what I'm going to do now is I'm going to show you what website to go to, and then I'm also going to paste it in the box here, and I'm going to show you the IRS's website, which quite honestly, to me, is just confusing. Because there's a lot of paperwork that is involved here. But if I could share my screen, which I can, good job. Here's really two things. And I'm not a fan of complicating anything that doesn't need to be complicated. Okay, you have two main things here, right? This is the actual IRS's website that shows you what this credit is. Okay, you could spend all your time going through these PDFs. I certainly have. They're long, they are drawn out. And could you do this on your own? Maybe, right? You could also try to represent yourself in court, but we wouldn't recommend that. So to have a professional service done for you and use this to determine, 1 second, and use this to determine whether or not you're eligible, we've made this virtually seamless. So what you would do is you would go to this website, and I'm going to throw it in the chat box. The website is ercfasttrack.com/LWE. So again, it's ercfasttrack.com/LWE. What that's going to do is bring you right to this website. All you have to do is set aside 15 minutes of your time, right? Now, this isn't something where there's no effort involved. Okay. We do need you to answer some questions to give us a preliminary amount, right, that we can determine if you qualify. Really, where the rubber meets the road is when we pull the transcripts from the IRS and we get those transcripts back, and it will, solidify what the actual amount is. Because I'm sure, I'm sure a lot of you, again, 2020 and 2021 seems so long ago. What I generally recommend people do, especially if you have children, is look at the days the schools were shut down, look at the days they were sent home. If you were taking care of a family member or you were homesick, all you want to do is keep those documents on the side, right? Because ultimately what's going to happen here is this. You're going to go and you're just going to hit simply begin qualifying. Now, you're going to go, and I'm not going to spend all the time today really going through all the questions. I recommend setting about 15 minutes aside to go through these questions. What'll happen is it'll tell you right away, you either qualify or you don't. Now, when it tells you you don't qualify, there's nothing else you should do. When it tells you you do qualify, the next steps are going to be to give us your actual information so we can go ahead and pull these transcripts. Now, some of you may have these transcripts readily available. What we found is we're all business owners. We're busy, right? We generally don't have this stuff handy. So again, we will go ahead and pull the transcripts with the IRS. And in about a week, right? In about a week, you will know the exact amount that you're eligible for. And then at that point, you could decide whether or not you move forward. Obviously, the fee is $1,995. Again, you could put it on a credit card. If you just have the money, you could pay for it however you want it. We're designed to handle volume. Okay. Again, this is all algorithms in the background that's doing this work. We're designed to handle volume. As of right now, because of the time crunch, right, with about 16 million people roughly eligible. And the truth of the matter is it's probably larger. We just don't know because as you guys are aware and ladies are aware, a lot of you may have multiple LLCs for various reasons, right? You can only claim the credit once. It's not something where you can claim it, twice. In addition to that, if your spouse is also eligible, you can't use the same days, right? So you were, taking care of your children that were home from school, you claim it, your spouse can't claim it as well. But what I recommend is let the professionals do the work. Let the system go through the process because as of, 16 million people being eligible, we're prepared to handle about 10,000 claims a day as it sits right now. And again, there is a deadline. I'm not big fans of deadlines. You know, they're often used, you know, in marketing to kind of like give you this sense of scarcity. But the truth of the matter is that credit, the first half of it, will go away on April 15th. And you will lose roughly 46% of what you're eligible for. So what I highly recommend, okay, and again, I'll put this link right in the chat box here, so it's a little bit easier for everybody. What I highly recommend is that you do set aside time. If you're like me, I tend to put these things last. I don't recommend that because, you know, let's face it, money's money. And if you don't take it, you lose it, right? So you pay your taxes, you're hardworking, you know, you're going out and you're doing your thing there. I just put it in the direct message, Tim. So I don't know if it needs to be reposted, but I recommend that you highly, you know, take advantage of it if you're eligible. If you know for a fact you're not eligible, of course, do not move forward, right? Don't move forward. If you filed, everyone always asks these little nuanced questions. Did you file a Schedule SE? That's really all you have to know. If you filed a Schedule SE, you are eligible for this. Now, what we find is a lot of business owners, right? As a lot of business owners, a lot of times you, right, have a business filed a Schedule SE for that purpose. Every single time I direct everyone back to this question, and I can't repeat myself enough. Did you file a Schedule SE, right? And again, I see questions that are popping up. This is awesome. Just to be very clear, I am not an accountant. I'm not giving accounting advice or any financial advice whatsoever. That's what we leave the processor for, right? What we are is we are the marketing arm for this company. So we go out there and we get in front of quality groups like Tim has here, and we make them aware of it. We have professionals in the background that actually do the work with the IRS and do the calculations. So I just want to be crystal clear on that. A question popped up. Is this only related for COVID-related illnesses? Correct. When the government, it's not, you know, God forbid someone's battling cancer and you're taking care of them. That would not make you eligible for this. Now, if they had COVID, right, or they thought they had COVID, their doctor said stay home because of COVID, that's a whole different animal. But if you were purely just taking care of someone that had a battle with cancer, and I've had 2 parents go through it, so I know what it's like. Luckily, neither of them were affected during COVID. But if they were, again, that would be a reason that you could potentially qualify. So I just want to be kind of clear on that. Again, I'm not here to make it any more than it is. We've had a lot of businesses, I mean, literally upwards of 20,000 that we've helped and recovered $2 billion in funds for them. Personally, the same company that did this is the same company that's behind what's considered the self-employed tax credit. So they're the ones that do this. On the business side of it, they have the attorney generals on their board. They have the current trial attorney for the U.S. Department of Labor. So this isn't like a fly-by-night company. And the reason why I say that is what you'll see out there in the marketplace is a lot of people either don't claim the credit or are discouraged from claiming the credit. Why? I have no clue, right? What I do believe is that most people intend to do the right thing, but there is unfortunately bad actors, right? There are people that try to come up with, you know, fake Schedule SEs and all that good stuff. It's not going to fly with us because we are one of the only providers that I know of that directly taps into the IRS's website, right? And the IRS's background there. And we're an official software provider for them. So we've gone through the hoops. We've successfully recovered a ton of credits. A lot of the little nuances of questions that you may have, I may not have the answer for. You know, the reality of it is if you just follow along with that quiz will do all the work. What I recommend you doing beforehand is I do recommend you doing a memory jog, right? Because every day counts, right? Every day counts towards this credit. So I recommend you do a little memory jog, maybe look in your email database, right? Were you getting emails from school that were closed down? Maybe look at some text messages that you had going back to family members, right? That were sick and affected by COVID. All those days count, right? But at the end of the day, it's up to you to kind of do that. The only thing we can do is we can pull the transcripts, but it's up to you to go ahead and go through that form and attest to what went on. And we hope.
Adam, let's hit on a couple of those. So first of all, I love that you guys are the who to do the how, right? Like that's the conversation we're always having here is like, I'm not doing this, right? Chances are most CPAs don't know how to do this. They're going to you guys anyways. I know you guys are one of the biggest in the country, which is why I trust you, which is why I would put you in front of my audience, right? And be able to share this because I know the time constraint is tight, which is why I think this is really important for everybody to get out. But I think the who to the how is a big part of what you were talking about. Talk about what you were just mentioning, like what are questions that we can ask ourselves to jog our memory on the timelines and on this stuff. So you mentioned going back to text messages. I delete all my text messages. Could go to like my Google Calendar. I could go to, a paper calendar if you have one. I guess search my emails. Like what are the right questions we should be asking ourselves? Was I sick? If so, when did I go to the doctor kind of a thing? Was my spouse sick? Were my kids sick? When were my kids home from school because COVID shut down the schools? Anything along those lines, right?
Yeah, absolutely. So again, the quiz is going to do a lot of the work, but the questions I always kind of encourage people to ask themselves is school is pretty easy. It's cut and dry because you had notices, right? You had notices and, I was in Hoboken at the time. That's where I lived. I'm now in Boca Raton, Florida. I mean, my apartment building, literally everybody was in there. I heard the kids screaming, husband and wife's trying to work.
Yeah.
So that's the first thing, right? So it's really about income in days. That's at the end of the day, it's income in days.
Is it like the PPP or EIDL where your income had to drop in order to qualify for this or no?
No, as a matter of fact, you have to have a positive amount on there. So we recommend anybody that's had $50,000 or more in positive net income to file for this. If you didn't, the juice may not be worth the squeeze, right? So we're not here to, if you're eligible for, look, if you're eligible for $3,000, you could put out 2 to get 3. Does it still make sense? Obviously, right? But that's not really, if you're going to go even money, it's just not worth it. I'm just being honest with you.
Is it taxable?
No,
income?
It's not
taxable. All right, so we don't have to start calculating. Hey, I'm in a 40% tax bracket, so I'm paying $4,000 to the government anyways, or like whatever, right?
Yep.
Okay.
I'll give you here, Tim, just some questions that I write down when I'm dealing with individuals. Is basically, did you have to like I'm from Jersey, so originally during COVID, that's where I'm from. We were shut down completely, right? I'm sure a lot of you saw that one gym that kept getting the doors kicked in because they kept reopening. So did you have to comply with any government COVID-19 quarantine or isolation orders?
Yeah,
right?
Everybody. Yeah.
Were you symptomatic or sick? No COVID test was required. Were you symptomatic or sick during the COVID period? Did you receive any side effects to vaccinations and have to go to vaccination appointments? Did you have to take care of a child, spouse, or family member that had COVID symptoms? Okay. Was childcare unavailable? A lot of people had childcare unavailable to them. You were the childcare, right? Was your children, was school canceled and they were sent home and they were doing remote learning? Okay. That's an easy one there. How long was your child home due to remote learning? That's really a big one, right? That's a really big one. So those are kind of what we call the childcare credit calculations. And then, self-employed work interruption. If you missed work due to personally due to COVID-19 issues, the credit is basically the lesser of 2/3 of your daily income or $200 a day, right? This is how we go in the background and we figure it out, right? So that's how we do that. And then again, the net income, we recommend $50,000 or more. So if you're talking to somebody that's, just early in their career and, there was no positive income, it's not for them, right? So your income had to be affected by the COVID pandemic.
What about like depreciation offsetting my active earned income? Any idea? Can you speak to that?
I actually can't.
CPA question.
Yeah, again, you guys are so good at what you do. I wish I was half as smart in the real estate space. But when you're talking depreciation and all that, I don't know how that factors in. What I do recommend is that you just, again, you go to that quiz and let that quiz do the work. I've been through it 15, 20 times. I don't remember seeing any depreciation. It's just really what it is it was money set aside. Hardly anybody claimed it because it wasn't well known. When we started dealing with business owners were collecting a lot of money from these credits. But what about the self-employed individual, right? And, it's everything from, a realtor to a Uber driver to, I mean, so many people had side income. It's kind of crazy. So that's
Well,
really,
I'm texting my team as we're talking here, and I'm like, dude, you were 1099 here, you were 1099 then, you were like, this is something you qualify, and it's like, it's extra income to our team members, right? And boosts everybody up. And so, yeah, if you have a team of real estate brokers or a sales team or anything along those lines, like it's again, can't say free money, right? But it's a tax credit and grant money to then be put towards people who were adversely affected. And guess what? We're paying the friggin' tax bill on this thing anyway. So you should be able to claim it if you qualify for it. So
yeah, absolutely. And it's a check to you unless you owe back taxes. If you owe back taxes, they just apply it towards that. So
yeah.
it's a nice way to kind of play catch up. The only thing I would say is unemployment benefits will affect it. So if you were collecting unemployment during that time, that'll factor into the equation. But other than that, that's really it.
All right. So the next steps would be talk to your CPA or did you file a Schedule SE, right? Figuring that out. If you did, then you just go to that link and you fill out start answering all the questions, and you just follow the path from there, right?
Yeah, most people don't even have to go to their CPA, to be honest with you. They know whether or not they filed a schedule SE. Whether or not you guys want to do that, it's kind of like a double dip, right? You're going to go to them. They're going to probably give you their opinion. We specifically focused on 2 credits, right? One to help business owners and now one to help the self-employed individuals, to the point that major companies, for instance, like Celtic Bank, which I believe is the 4th largest SBA lender in the country, actually ran their ERC credits through us. A lot of accounting firms ran it because it's a headache for them. Remember, it's more of it's not, well, in this case, it's an income tax credit, but typically with the other one, it was a payroll tax. They don't even understand payroll taxes, right? They just, they go off into the wind just doing their things. So yeah, I would recommend them first go to the site. If you want some sort of backup, you could ask your accountant, but keep in mind, he or she, there's a good likelihood that they're either using an outsourced service like this because they just don't have the manpower to do it correctly, right?
Yeah.
It's not easy.
Well, I meant just to ask if you scheduled a file or if you filed a Schedule SE, I guess more just that. But you're saying you just go there, answer the questions on the site, and then I'm sure there's some sort of secure link where you put in your social security number and it pulls up your tax return and it'll tell you, yes, you did schedule an SE.
Yep, you're gonna go. What we did with the website, right, is we ask questions up front, so there's nothing personally identifiable to you because there's no reason to ask you for any personal identifiable information unless we know that you qualify. At that point, when we say, hey, you qualify, that's when you're going to enter your personal your personal information that allows us and gives us permission to pull the form from the IRS. And then that's when the accountants get it in their hands, they go through it and then deliver you that amount you're due within about a week. It is taking a little bit longer just because there is a lot of people applying for it. So again, when it comes down to priorities and kind of what you got going on, we all got a lot of stuff going on. I just recommend maybe on the weekend or whatever the case may be to go through it because let's face it, whether it's 10,000 or 32,000, it's a lot of money.
And that fee, the $2,000 or $19.95 that's paid, that is done on a credit card at the completion after you already know how much money you're going to make or get back from the government. But that's paid right then and there in order to finish the filing. You guys file it, and then the money comes, let's call it 2 weeks later.
Yeah, depending on, again, there's e-file, and then there's people that filed regularly. People that have e-filed, I would tell you that give it 4 weeks for the money to come in. If you did an e-file and you filed traditionally, it will take longer because obviously there's paperwork they got to sift through. So
Okay.
I would say I'd be comfortable telling your audience 4 to 12 weeks.
Got it. All right, dude, super helpful. Super thankful that you guys brought this to my attention last month when I think it's just like so many people don't even know that this exists, and I think it needs to be known. And so appreciate you guys being here. Thank you for sharing that insight. And then again, guys, the link is right there in the chat box if you have any interest or you want to share that with whomever that might have been 1099 or had some sort of a gig type opportunity or job or service during 2020 or 2021, right?
Yep, absolutely.
Awesome. Any other closing thoughts or any other questions that you guys might have? We spun some heads today. There's a lot of great stuff on tax credits, tax strategy, grants, and all that kind of stuff. Tax deferrals, really good. So, all right, can we show them some thank yous? Appreciate you guys being here. Mark, Adam, you guys are rock stars. Thank you so much.
Appreciate it. Thank you.
All right. Cool. So that concludes the training today, guys. So hopefully you guys got some great insights, got your head thinking about some different things and thinking a few more chess moves ahead, right? Not of what's happening right now, but thinking a couple chess moves ahead. That's how you win the game in this tax world and tax credits and tax strategies. And you got some amazing resources, the who's to do the hows, the who's to do the what's. Reach out to them, do business with them. Like whatever you guys want to do, they're people that I look up to and that I do business with because I know that they're some of the best in the entire country. And that's why I put them out here to share those resources. So you don't have to go through all the bad CPAs and the bad tax strategists and the bad companies. And that way you get plugged into the good guys right out of the gate and consolidate those timelines, right? Consolidating the timeline is what it's all about, being in these rooms and being in the right communities. And so with that said, like I'd love to extend an invitation to anyone who wants to come out and check out Legacy Family. Would love to have you guys out in New Orleans in 2 weeks. We're gonna be there February 28, 29. You'll be able to meet Melanie and Byron and Chris and I don't think Mark and Adam are coming, but I can connect you guys anytime as well. My entire team's going to be there. There's so many rock stars in Legacy Family. I'm excited to see everybody. It's like Christmas 3 times a year when we meet up. So if you guys want to come out, you're more than welcome. I would extend an invitation for you to come buy a one-time ticket, test it, and then if it makes sense and you resonate with the group and you see how much value there is there, then we could talk about joining as a member. And so we'll put that link in the chat box as well and in the comments on social media, so that way you guys can tap in and get your ticket. All you got to do is get your flight out there, get your hotel room. That'll all be everything else is squared away with food and drinks and social activities and transportation to the social activities and all that stuff. So all righty. Well, I appreciate you guys. Hopefully you had an amazing training. You got some good insights, and I hope you go and put it to work. So appreciate you. Have a great weekend, y'all. Be your best. I'll see you.